What is Days Sales in Inventory? Days Sales in Inventory, DSI, also known as Days in Inventory, D2, is a financial metric that indicates the average number of days a firm takes to convert its inventory, including works in progress, into sales. It serves as a liquidity indicator for the inventory held by a company, reflecting how long the current inventory stock will last. A high DSI suggests inefficiencies in inventory management or difficulties in sales, while a low DSI indicates effective inventory and sales optimization. DSI is calculated by dividing the average inventory by the cost of goods sold, COGS, and multiplying the result by the number of days in the reporting period. Another approach involves using the inverse of the inventory turnover ratio, highlighting that lower turnover corresponds to higher inventory levels. This flexibility allows companies to adapt their calculations based on specific accounting practices. For instance, if a furniture retail company, Hulk Furniture Mart, reports an average inventory of $80,000 and a COGS of $400,000, the DSI can be calculated as follows. With 360 days in a year, the DSI would be 72 days, indicating that it takes the firm, on average, 72 days to sell its inventory. Alternatively, if the inventory turnover ratio is known to be 3, the DSI would be calculated as 120 days, meaning it takes about 4 months to convert inventory into sales. The interpretation of DSI varies by industry, and it's essential to compare the figure with peers in the same sector to assess inventory management efficiency. A lower DSI signifies effective revenue generation and inventory management, resulting in reduced handling costs and improved cash flow. Conversely, a high DSI can suggest excess inventory, potential obsolescence, and increased losses. Analysts utilize DSI to gauge sales efficiency, determine optimum inventory levels, and evaluate the effectiveness of inventory controls. It is particularly valuable for retail firms and those dealing in perishable goods. However, DSI has limitations. Adjustments, such as inventory write-offs, can distort the metric. Aggregating fast and slow-moving inventory types may lead to inaccuracies. Significant changes in calculation methods can render DSI figures incomparable over time. And using end-of-period inventory balances may skew results. Additionally, DSI may not accurately reflect a company's situation if production is outsourced, resulting in reported zero inventory. In efforts to boost sales, reducing prices might lower DSI at the cost of profitability, masking underlying inventory shortages. Thus, while DSI is useful for peer comparisons, it may not serve well for cross-industry evaluations.